introduce a little bit what we'll be discussing today. Looks like we
Okay.
have a good number already. I like when people are punctual. First, I did get a question about this already. Um, this fly haircut I have, it is not me violating social distancing rules. My beautiful wife, Ashley, took a buzzer to me yesterday. I think
Wow,
the most fun we've had in weeks.
I'm
Um,
sure.
so
Looks good though.
yeah, yeah. And so as folks are coming in, I'll remind people about this throughout the presentation, but I'll be moderating the Q&A for Rachel. So if people want to ask any questions they have as we go, I'll be keeping an eye on that. But I'll briefly introduce who everyone is and then we can get started.
Okay.
So my name is Harlan Milkov. I think most people on the line are familiar with Foundational already, but we are a firm that helps early stage startups plan and implement their early stage capital raises, mainly focused on seed and Series A. We use a very data informed approach to identify the most active investors in certain spaces and help teams form their whole fundraising strategy around that, including things like pitch narratives and objection handling and all those good things. And joining us today is Rachel Jenkins, VP of Customer Success at Founder Shield. Founder Shield's also data driven. They provide insurance to, they're an insurance brokerage focused on high growth companies, including early stage startups. And Rachel has been with the team for many years, focusing on policy language, is my understanding, and mainly with companies in on-demand platforms, SaaS platforms, financial-related startups. Sounds very New York appropriate. Anything else Rachel would like to add, I'd welcome her too. And today she'll be discussing risk management and insurance policies for early-stage companies. It seems like everyone today is either thinking about managing risk or how to manage risk while growing, hopefully. And I'm sure it's very timely for many of those that have joined us. So Rachel, I'll hand it off to you.
Awesome. Thank you, Harlan. So, okay. So, we have a phrase that we like to use at Founder Shield, and it's, think of insurance as a sword, as opposed to a shield, right? And a lot of our clients come in, reach out to us, different time periods, looking at funding, putting in place that first contract, those sorts of, operations at the company. Here at Founder Shield, we like to say that, when you're approaching that seed round and, getting those revenues up and running, it's a lot more helpful to kind of have your risk management program up in place, quoted, policies bound as you're approaching, raising funding and putting in place contracts. A lot of companies, they think of this as a kind of check the box, which, when you're starting your company, you don't necessarily have a lot of capital. You're very budget, conscious and whatnot. So, it makes sense why you might think about insurance that way. But, hopefully after the presentation today, you'll understand some of the considerations that go into kind of making sure your risk management is fully in place, prior to approaching those milestones in your company. So first, I want to kind of talk about risk management in general. There's a lot of different frameworks out there. You could do a quick Google search, to find out different ways to kind of approach risk management. I think overall, there's kind of a few different items that go into the process of really analyzing your risk and making sure that you're prepared, right? Looking at those frameworks, the thing to look into is identifying the risk, right? So understanding operations, where potential from issues, in terms of operating the business, assessing. So, what controls and protocols can you put in place to kind of mitigate those risks? And then prioritizing the risk, right? So not every risk is insurable, from that point, but a lot of different usual business exposures are, right? So insurance comes into play when you're talking about treating the risk, right? So there's different ways to do that. You can avoid the risk, you can reduce that risk, and you can share that risk. So insurance is really sharing the risk. So, a couple things that are important to keep in mind, when you're approaching insurance procurement process. The main thing that I communicate to a lot of our clients is carriers and underwriters are stakeholders. Easiest way to think of them is as almost like an investor, right? So they're interested in the growth and development of the company. They want to understand where you see your risk at, what steps you're putting in place to mitigate that risk, and how you guys view operations going forward. The more information, the more comfortability that you can give carriers and underwriters, the better that pricing will be. And, the more comprehensive your insurance coverage will be, right? You won't have a lot of those issues where you thought you were covered here, but actually you weren't covered, right? So that information and, taking care to treat underwriters as stakeholders, that really comes into play. And just to kind of go onto the information aspect, right? Information is currency when we're talking about insurance, right? So the more you guys can detail your protocols that you have in place, right? So looking at things like having proper contracts in place with vendors, limitations and liability. Those are the sorts of things that insurance carriers are looking for when they're reviewing the risk, right? Lastly, one size probably does not fit all. So, when you're coming out the gate and you just need insurance quick, you might just do a quick search and kind of go with the first broker or the first carrier that you see. That's not necessarily a good approach, to putting in place insurance. You want to make sure that you're partnering with a reputable carrier. You're partnering with a broker who understands the dynamic change that can occur when you're operating a startup. You just want to make sure that everyone is on the same page with regards to your exposure, and make sure that your policy is covering the things that you are exposed for. So that's kind of a general kind of level things to look for when you're putting in place your risk management program, right? So you want to make sure that you analyze and understand your risk. You're putting in place protocols and procedures to minimize that risk, and then you're sharing the information with your carrier, with your broker, on how you guys have implemented these procedures and on how to manage your risk. So now I just kind of want to start looking towards the actual policies and whatnot that you should have in place, as you go through kind of the phases of business, from the seed round to putting in place contracts to eventually, raising that first major round, Series A of funding. So, it's easier to think about insurance in different phases, right? So, we mostly break it up into kind of 3 different phases. So phase 1 is kind of that seed round, friends and family round of funding, where you're getting operations up and running, putting that business plan to action, right? So there are certain coverages that you just need once you get out of the gate. So the first one, which most people are familiar with, is general liability and property insurance. So the easiest way to think about general liability is kind of that slip and fall coverage. In this current time, there's not necessarily, people coming into your office or your store, but the easiest example is, someone comes into the office, slips and falls, and now, they have bodily injury. It's also, a requirement for leases, and you don't want to have a situation where you've gone through all the contract negotiation with, a lease, a landlord or whatnot, and now you're trying to get the keys, but you don't have the proper insurance in place. Another part of general liability that we like to see is property insurance, right? So the property insurance that's looking at, the business owned property. So things like computers, laptops, those sorts of things, desk chairs, improvements that you've made into space to make it more comfortable for your employees. You want to protect that. Should there be a fire, in your location, especially, in this situation that we're looking at now with, COVID, business interruption comes into play there a lot, where your location is no longer operable, right? So you want to make sure that you have the insurance in place when we're talking about general liability and property that can respond to a physical loss that makes your office unusable to customers and employees. So the next coverage is workers' compensation. So that's legally mandated, across the 50 states. Depending on the state, you might have to go through the state government or, provide your own private workers' comp insurance. And, there's different regulation when it comes to that regarding when you need to have it in place, especially if you have independent contractors and whatnot, doing a lot of the work, as a lot of our clients do. As when you're starting up, you might not necessarily have the capital needed to have full staff on hand. You employ a lot of independent contractors. You want to make sure that your employees and your independent contractors are covered, to avoid issues with the state. The next coverage, which is really a hot topic these days, is cyber liability. So, I was looking at this article, from Hiscox, and they were saying that 43% of small businesses will have a cyber breach, right? So it's a high percentage, and the average cost there, around 200,000, which is high enough to put a small business, just starting business, into bankruptcy, right? So having that cyber liability is really essential to that phase one launch, especially if you're collecting customer information, and especially if you're a focused company, right? You want to make sure if there's situations like a cyber extortion or a business interruption where you have, your system critical vendors shut down, you want to make sure that you have the protection in place to protect the company and respond and provide costs for forensics and consultant public relation costs to help you manage through a cyber extortion or business interruption event. So those three coverages are probably the ones that you definitely want to have as soon as you get out the door. There's a lot of considerations that go into place with having those coverages at the early start of your company, right? With smaller revenues, smaller number of employees, you're going to get a lot of premium considerations that you wouldn't necessarily get if you waited to put something like a cyber liability policy in place further down the road.
Rachel, we did have a question on this slide, I believe. I think it was regarding workers' compensation. Is that insurance specific to U.S. labor only, or is it globally applicable?
So most countries have their own form of workers' compensation. Over in the UK, they definitely have their own version of workers' compensation. You might see it as employer liability. It's on a federal level or a country government level. It definitely varies, but most of the countries that a lot of our clients operate in, whether it be U.S., Canada, over in Europe, there are a lot of regulations in place with regards to workers' comp. And if you have employees that travel, to foreign countries, you definitely want to make sure that you have a policy in place that will extend workers' comp benefits to employees as they travel as well.
Thank you.
Awesome. Oops. Okay. So the next coverage that a lot of companies look at, as you're launching and you're approaching contracts, right? So the first three coverages are what you should have kind of looking in that first kind of 90-day cycle of company operating. You definitely want to have those in place. A lot of companies have what I would call kind of a ramp up period, right, where you're getting the structure in place. You're not necessarily engaging with customers yet, but you've kind of got the plans in place, right? So once you have those plans in place, you might want to start looking at errors and omissions, and especially a tech platform. A lot of the cyber policies include extensions for what we call tech E&O. But when you're looking at errors and omissions, it's really protecting you against errors and omissions and, failure to, correct issues when you're looking at your technology or your software that lead to a financial loss for your customers, right? So a lot of you who operate kind of SaaS platforms, this coverage is going to be really essential as your customers or product operate some facet of their business day to day. So when you're looking at errors and omissions and cyber liability, back to my point about having coverage in place while you're small, definitely when you're looking at the errors and omissions and cyber liability, that comes into play, right? So those policies, they rate predominantly on your revenues or your projected growth, right? So year one, those revenues might be lower, and you can take advantage of those premium considerations of operating a smaller company as you continue to grow, as the increases will be more in line with that initial premium that you have in place. Okay, so the last one of these kind of five coverages that I think are important to kind of look at as you get up and running is commercial crime. So that looks at employee theft, and this is really important when you have customers where your independent contractors or your employees will have access to their information, maybe sensitive financial information and whatnot. We see that as a requirement in a lot of the healthcare field in the financial technology space. So comprehensively, general liability, property, workers' compensation, cyber liability, errors and omissions, and commercial crime. Those are the coverages that we're seeing a lot being required by contract, right? So just to kind of tie it together with kind of the previous slide, and how to use insurance as a sword, you want to make sure that you have these coverages in place. So when you go to bid on a contract, that process can be smooth, right? So there's not issues where there's a timing issue where you're trying to close a really large contract, and now you're trying to put in place that commercial crime or errors and omissions policy. Those policies, they take time to quote and put in place and make sure that you have the right wording and right retentions. And retention means basically your out-of-pocket spend before the insurance kicks in. So you definitely want to make sure that you have an idea of kind of what those policies might cost. You might want to have, quotes lined up so you can put those in place, as a binding. But you just want to make sure that you're prepared before you enter into kind of sourcing contracts with your customers, rather than kind of ad hoc add these policies as they come up in contracts, and kind of deal with the effects of trying to get quotes short term and kind of maybe having a higher premium than you would potentially have if you spent a little bit more time, preparing to have the policies in place.
And
so,
Rachel,
yep.
Question for you on the point of errors and omissions. We had a question about an example of one, maybe a really common error and omission that someone might want to insure against.
Mm-hmm. Yeah, so I talked a little bit about the tech platform, right? So you have, I'm sure, if you are operating a platform as a product, right, for your customers, you might have coders going in and inputting, making changes to code, all the time. Say a coder puts in the incorrect code and now it's caused a systematic issue with your platform, and now customers are no longer able to access the platform to do what it's intended to do. That's the easiest way to think about errors and omissions. Another example would be more of a professional services company, right, that is providing recommendations to their customers, whether that be financial recommendations or health recommendations. Say those recommendations, you recommend a specific vendor that a customer partner with, and that vendor wasn't properly vetted, right, and causes a financial loss to that third party, that customer that you were partnering with. That's where errors and omissions comes into play.
Thank you. And also a question about commercial crime. Does this cover things like credit card fraud or other common maybe transaction problems?
Yeah, so there is an insuring agreement when we're looking at commercial crime that deals with fraud with regards to credit cards, debit cards. It's mostly kind of tailored to your employees, right? So when you have a startup, I'm sure there's a lot of controls around who has access to the company corporate card. Or maybe several individuals have their own corporate cards, right? And, the situations where they're using the corporate card for expenses that are not supposed to be, covered by the business. They're not business expenses, right? So, the commercial crime definitely can come into play and provide coverage there. Now, when we're talking about actual, third party credit card fraud, depending on the type of vendor and the type of customer and the type of coverage that you have, this policy can respond there as well. And that kind of goes back to my point about, using information as currency and partnering with the insurance carrier and underwriter as a stakeholder. Those sorts of perspectives on insurance really go a long way when we're looking at coverages like commercial crime, where it's highly customizable to your risk.
Thank you.
Awesome. So, what I would say is, general liability, property, workers' compensation, and cyber are really kind of your phase one coverages. And, to add to that, when you enter to that phase two, right, where you're sourcing the contracts, driving revenue, that's when you kind of want to look at errors and omissions and commercial crime. And then, so moving to kind of phase three, that's the kind of initial, large round of funding, right? So you're looking to your Series A, you're looking to try and capture the interest of potential outside investors and whatnot. There's a couple of other coverages that you definitely want to look to at that point. So the first one I want to mention is directors and officers liability. I'm sure a lot of you have heard of it. The easiest way to think of it is management liability protection, right? So it's protecting the directors and officers, the decision makers, from liability arising out of, misrepresentation, I think is the major idea there, with regards to either, shareholders, customers, regulators, pretty much any kind of stakeholder that you can think of, bringing litigation against the company. Directors and officers, depending on how you have language set up, could probably respond there. A really good claims example would be a potential customer reaching out to you and basically saying, we have a big contract, but there's certain kind of human and financial capital requirements. A misrepresentation in that situation could be, the directors and officers kind of leading that customer along and saying, yes, we can, hit your requirements, closing the deal, and it comes out that, that capital, it does not exist and you're unable to fulfill that contract, right? So that's a type of D&O litigation. Also, it protects against the the financial, personal assets of the directors and officers, right? So there's a fiduciary duty on the board and senior management to, you know, manage the company transparently and, you know, from a regulatory perspective within that framework, right? And, you know, within the framework of, you know, the agreements put in place between the board and the shareholders. There are certain situations where the company is unable to indemnify the individual board of directors, and sometimes, you know, they're legally unable to, right? And those sorts of situations, you want to make sure you have protection in place so that the individuals don't have to go into their pocket to protect themselves from that litigation. I think, you know, when we're looking at directors and officers, another important aspect, you know, that goes back to raising funds is that directors and officers coverage that can be used to attract outside investors, right? They want to be sure that you understand risk, you analyze your risk properly, and you understand the exposure that asking an outside investor to the board represents, right? So having that policy in place before you actually close that round of funding is really essential to attracting those investors. Also, an important thing I want to note, because it comes up a lot with our customers, is when you're looking at putting in place that directors and officers insurance, you want to definitely have it prior to the close of the funding, right? Because you know, majority of all of these policies, but D&O in particular, they have what we call a retro date. So that means that once the policy is you know, put in place, it's not going to cover any past acts, right? So if there's an issue that arises out of you know, funding and raising those funds, that could potentially not be covered if you wait till after the funds are raised to put that policy in place, right? So it's really important when you're anticipating doing that fundraise that you do look to put directors and officers coverage in place. Lastly, another thing that potential investors like to see is employment practices, right? So the employment practices, that looks at the hiring and firing practices of the company. And, you know, a lot of customers or a lot of our clients don't necessarily initially see why employment practices is so important, but, you know, on the other side, we probably see more employment practices claims than, you know, what you would think would be the usual, like maybe a commercial crime or, you know, a general liability claim, right? Because when you're starting your company, you have a really, you know, tight, you know, number of employees, and, you know, as you start to raise funding, there might be, you know, issues with succession, right? And the initial, you know, founders or whatnot being kind of repositioned in other positions in the company, or maybe, you know, potentially even being pushed out, right? So the litigation that can arise out of, you know, how you handle, you know, firing individuals or, you know, repositioning them within the company is very crucial, right, to maintaining operations and showing investors that you take risk management very seriously, and you have that approach to your employees as well. Another thing I want to note is that I saw a question around the procedures or whatnot that you should have in place, right, when you go to an insurance carrier. You can use the applications that you see, you know, for employment practices for directors and officers in crime, you know, along with the other ones, as kind of a guide to use to know kind of what procedures and protocols can should be in place, right? So, for example, employment practices, they ask, you know, do you have a manual with regards to, you know, harassment and those sorts of things, right? So having the proper things in place before you approach getting quotes can really be efficient and using the application as a guide of what kinds of things to be putting in place as you enter in that phase 3 where you're raising a round of funding can be really helpful and useful overall to the company and how you're able to present yourself to potential investors. Okay.
And yes, Rachel, we have one other question regarding employment practice insurance. Is there a rule of thumb founders should be thinking about in terms of when they should add this to their coverage in terms of maybe number of employees or some other test like that?
Yeah, for sure. I mean, I think that overall, if you're approaching more than kind of 10 employees, it's something that you should be looking at very seriously. Now, when you're looking at employment practices, it kind of goes back to kind of analyzing your risk and understanding your exposure. If you're a company that has a lot of customer-client interaction, where you have a lot of third-party exposure, maybe that's something you look to put in place before you even get to 10 employees, right? Because this policy extends that kind of liability arising out of harassment and discrimination to third parties and to customers, right? With that being said, also, if you're a very small company with a high amount of revenues and, you have a lot of founders and what, I might want to look into that as well, right? Because at the end of the day, when you're talking about emotions, it's better to be safe than sorry. And those costs for litigation can rise very quickly when it comes to employment practices in particular. Were there any, was that, okay. All right, so now to just kind of summarize, the coverages that we looked at and kind of the best approach to, risk management. I have a few kind of do's and don'ts that, if you kind of apply that to your risk management or your insurance procurement process, it should allow you to kind of get the best terms and best pricing in place. So, be transparent, right? So you want to be honest with your revenue projections. You want to be able to provide, sound financial information about the company. And, if the company is going through a little bit of financial troubles, be transparent about that as well and explain your plan to get back on track and how you plan to, sustain operations, in the coming years, right? So like I said, information is currency. It's very key. The more clear you are about your operations and your plans, the easier it is for your broker to advocate on your behalf and for your carrier and your underwriter to offer you the best terms and the best pricing. So this is an important one, and we find a lot of our clients that come to us with coverage already in place struggle with this one. Double check your classification and your coverage. All right, this really comes into play, especially when we're looking at general liability, errors and omissions, and cyber coverage. You need to make sure that what you're buying actually covers what you're doing. For example, I had a client who came to me with their directors and officers policy, and they were a loan servicing company, and they had a loan exclusion on their policy, right? So that basically means that they were paying for a piece of paper. If a claim actually occurred, since their operations are loan servicing, it would be excluded, right? And another coverage that this comes into play a lot is with general liability. You want to make sure that your classification, it actually represents what you're doing, because if that is misrepresented, it can affect claims payments. And we've seen it here at FounderShield, situations where clients had policies in place where they were classified incorrectly, and when it comes down to it, and when you have the claim, carriers can use that as a reason to decline a claim payment, right? So it's really important that how you're being classified, how your employees are being classified, and understand kind of where the limits of the policy that you're purchasing exists. Another important thing is to communicate your budgeting needs. This is a really big one. Insurance, it costs money, and depending on your operations, it may not necessarily be cheap, right? So going into that conversation with your broker with a budget in mind, and actually asking questions, to your broker, so you can actually understand kind of what the range of the pricing might be, what factors in your risk kind of are, considered high risk for underwriters, right? So understanding, if you're in the healthcare space, or the, financial institution space, those are, more risky operations to an underwriter, right? So they are analyzing risk all day, and they have a good idea of kind of what appropriate pricing looks like for, different operations, right? So communicating that to your broker and the carrier, that can help you be able to get the best product, right? So the underwriter can use that budgeting information on as a way to be able to offer you, several different options, right? And internally what you need to be able to check the box. But if you're going to pay, for insurance, you should make sure that the insurance actually, will work and cover you for, those exposures, after you've prioritized, after you're doing your risk management analysis, right? You want to make sure that those major risks are covered, right? And understanding your budget and how much money you can actually spend, that comes into play there. So just to kind of reiterate, the first 3 points, right? Understand where you're covered and where you aren't covered. We always like to avoid at Founder Shield a situation where client thinks they're covered for something and they're not, right? So you have to make sure that you're asking those kind of claims scenario questions, so you have an understanding of the limit of the policy. Insurance policy is not, a situation where you just kind of pay X and, you're covered for, ABC. You're covered for everything. It's covering certain aspects of your risk. And if there's something in particular that you want to be covered as well, it's important that you communicate that to your broker and your underwriter. The last thing that is really important, and a lot of our clients that come to us, have this issue, is make sure you have a focused strategy and realistic timeframes, right? So partnering with a carrier should be kind of a long-term decision, right? You're looking to build that relationship in the insurance market, and having a strategy and a comprehensive submission is part of that. And, the last kind of item there, realistic timeframes, right? Some coverages can be quoted really quickly, right? So if we're looking at things like workers' comp and usually, general liability, those usually can have, 48, 72-hour turnaround. But when we're talking about the coverages that require a little bit more underwriting, it takes time, right? And you want to anticipate that this could take, 1 to maybe even 2 weeks to get the right policy in place for you. So, having that strategy and sharing it with your broker and setting those realistic timeframes can really put you in the best position to get the best quote and, buying the best policy. So I have one question that's focused kind of on the progression of policies, and kind of, when I was talking on the last slide about kind of the phases, you can approach insurance periodically throughout the year. our recommendation is always, try to kind of line up your policy dates, just because it always makes it easier on our customers with regards to having to submit, applications and whatnot, and just kind of handling insurance in one fell swoop. But, if you do want to take kind of the check the box approach, within reason, and you have a lease, in January, and you need general liability and want to get that in place, and further down the line, we can always approach putting in place other coverages later in that year. And then once you kind of have your full suite of policies, we can look to line that up with the renewal date and kind of make that ease of process after the fact. So, there's necessarily not a downside when you're initially looking to place policies to kind of do them intermittently throughout the year. But overall, we definitely recommend that, you line those up eventually, just because it definitely makes it easier on you as the customer. Now that we understand what you should do, what shouldn't you do, right? So the big one is falsify information, right? I mean, everyone wants kind of the cheapest policy with the most coverage. But what happens, if you provide information that's not incorrect, if you've had claims, prior to having insurance, and you communicate that to the carrier, we can have issues where you misrepresented the risk to the insurance company, right? And they could do all sorts of things. They could look to cancel your policy immediately. They can look to non-renew. And, the worst case scenario when we're dealing with a claim situation, they could just flat out kind of deny that claim due to misrepresentation, right? So it's very important that you have the right eyes looking at your application, right? So, having, your CEO and, CFO and, the individuals at the highest level who are making those decisions, you definitely want to make sure that they're giving an eye to what you're providing on the application. So you make sure that you don't have any issues down the line in terms of, not communicating the exposure properly to, the carrier, to the broker. Another don't is blindly price buy, right? So like I said, I think I've said it probably several times today. The cheapest policy is not necessarily the best policy. Like I said, we've had numerous situations where our clients have just bought the cheapest policy to check the box, and it turns out that the coverage really isn't there. And as insurance is a cost center, you want to make sure that the costs are appropriately allocated, as you would do with any other aspect of the business, right? So you want to make sure that what you're spending the money on is actually useful and can come into play should you need it. Because that's got to be the worst feeling ever of spending money on insurance, and when you need the policy to respond, it doesn't. Another don't is ignore your broker. So, I think that's a really important one to kind of highlight. I know everyone gets busy, especially you all who are starting a company, trying to raise that seed round or that Series A and, attract customers and whatnot. Insurance usually kind of is at the bottom of your list of things to do. But it's really important that you communicate with your broker, right? So if you move locations, you're opening a new revenue stream, those sorts of things, you want to make sure you're communicating that as soon as possible to your broker, because, insurance policies are contracts, right? So there are stipulations on the carrier in terms of claims payment, and there's stipulations on you as the insured in terms of when you're going to let them know with regards to different changes that are going on at the company, right? So, your broker might seem like they're, persistent, but they're really just trying to look out for you and get that information of changes over to the carrier as soon as possible, so your policy can be updated and respond where you need it to. We've had situations where clients move to a new office, and then a year later they have a property claim, and the location never was communicated to the broker, right? So you just want to make sure that you're maintaining that constant, open, pathway of communication between your broker. They are a partner, right? We at Founder Shield like to think of our position as brokers as an extension of your team, right? A lot of these larger companies, they have risk management teams, right? They have a dedicated risk manager. We know, as a startup, you don't necessarily have the capital to dedicate a risk manager, right? So we're here to assist you and answer questions and help, whether that be of how should the insurance requirements look for our vendors, and what sort of ways can we look to kind of mitigating our risk through insurance, right? So your broker is there for those conversations, and if you don't use that, then you kind of lose it, right? So and then the most important is wait until the last minute. So that goes back to kind of all the do's that I said. Like I said, insurance quoting, it takes some time, right? There's quite a bit of back and forth in between carriers and brokers and insureds, and you have to allow appropriate amount of time to have those conversations, right? Because if you have those conversations, the broker can negotiate on your behalf. We have a lot of situations where a carrier might quote a certain premium, and after a lot of back and forth, they're able to reduce that, right? By the client being transparent and communicating with their broker, and then the broker being able to communicate and educate the underwriter on the risk. Having the time to have those conversations, it really will benefit you in the long run. Because the carrier will see you as a partner and see that you are taking risk management seriously, and the broker would be able to kind of pressure the carrier to get you that best rate. So that's basically kind of what I wanted to cover today in terms of what an effective risk management program looks like, what kind of coverages might you need to have in place, as you're approaching phase 1 and phase 2 and phase 3 of growing your company. And, just to kind of recap what I said, throughout this presentation, communication between all parties is really what's going to make the process a lot easier for everyone. And having these policies in place and being able to reference them, and dealing with investors and dealing with customers is really going to smooth that process, right? Your sales team will be empowered to be able to source deals and close them, right? They won't have to wait, for the insurance requirements to be put in place and whatnot. And investors are really going to see that you take risk seriously, right? Because these claims can be the breaking point for a small business, right? If you have, right out the gate, a $200,000 cyber claim, it's hard to come back from that. And a lot of the small business companies, right, as you're starting, you're accelerating, a large, 6-figure claim can be enough to close the door.
Thanks, Rachel. We did have a few questions for you. The first is early in the presentation, you mentioned that there are some insurance policies that the price of which grows with your revenue. Do you have a sense of what founders should be expecting, those kind of core policies you recommend most startups carry?
Yeah, so in terms of policies growing with your revenue and kind of what policies you should have in place while you still have low revenue, it kind of goes back to I can't go back to the slide. But those policies really are, your general liability and your property. That's general liability is rated off of revenues as well. The workers' comp, that's looking at payroll. So, closely tied to, growth in revenues. And then the cyber liability, that's also looking at revenues as well. So, while your revenues are lower, it definitely makes sense to look at those policies and look at putting them in place and see if you can fit it in your budget. All of these different policies that I mentioned, they all, are rated off of certain factors, outside of maybe the directors and officers coverage, which is a little bit more comprehensively underwritten. When we're looking at the employment practices, they're looking at your employee count, right? So those numbers kind of set the basis of kind of where premium is. And then, the carriers look at the controls that you have in place. And that's how they are able to kind of factor in credits or debits that either are going to lower your premium or increase your premium.
Thanks. And we have some more. I also want to mention for anyone that joined us after we got rolling here, please use the Q&A feature in Zoom just to add any questions you have, and we'll be sure to have them answered. So Rachel, another maybe somewhat related question to that is, and I'm curious to know how you see it. How should founders be thinking about the probability that something should happen versus what they can afford to pay if it actually does happen? Do you have any guidance on that? Like, how much do they really need all of these products, I think is what the question is really getting at.
Mm-hmm. Yeah. So, I mean, that goes back to kind of where I started the presentation at, right? So, using a effective framework to analyze your risk, right? So, doing the homework, with your management team to identify your areas of risk, right? So if you're a healthcare company, your biggest risk is probably going to be around like HIPAA regulation, right? And protected information with regards to, protected health information with regards to customers and whatnot. So analyzing what your actual exposure is really the first step, right? So once you analyze, then you can take the time to determine kind of, the risks in like you can take the time to prioritize the risk, right? So, just to kind of stay on the healthcare, a healthcare company may not have the largest risk, with regards to a healthcare tech company may not have the largest risk with regards to, property insurance, right? And general liability with regards to actual offices and customers coming in. But, another company that, might be operating like from a consultant standpoint, they're going into customers' offices, right? And they're having those conversations. So just prioritizing your risk and understanding where the largest risk factor exists, that will allow you to kind of identify, okay, what's a need to have, what's a nice to have. I broke it down to kind of phase 1, phase 2, phase 3. The phase 1 policies, those are policies that usually a third party, imposes that requirement, right? So just to go back to the general liability, that's required by, I would say, probably 80-90% of leases, right? So you're going to have to get that. Same with the workers' comp. And when we start looking at, a little bit of the more kind of management liability policies like cyber and E&O and directors and officers, that really is, you really have to understand kind of where you are in the space of operating your business, right? So cyber, that probably is going to come into play when you start having actual customers who are either logging onto your platform or you're sharing information, right? And same with, errors and omissions, right? So the coverage is really driven by the interaction with third parties.
And I think that
But
is a line to balance. Some of these policies, I imagine, can be used as negotiating points because they cost money, and if people really want them but they're required by law, then you can negotiate around it. We did get one question around what I believe is called a key man policy. And just going back in time, this was important for Reonomy, a venture I had co-founded prior to Foundational. I believe Founder Shield actually underwrote that policy for us. We had a lot of know-how that we were pitching to the investors that wasn't implemented yet. And this was at the seed stage, so very early. And I believe they mandated we carry these policies. So in that case, if we wanted their money, we had to do it. But
mhm.
but the question we had here was just the broad category of those kinds of policies. And it was kind of a broad question, just if you could touch base on that concept. I don't think it really came up before, but just speaking from personal experience, it can come up.
Yes, for sure. And honestly, I probably should have included that on my initial list, especially with the directors and officers and employment practices coverage, kind of looking into phase three where you're raising that series A round of funding. Key person, it definitely comes into play, especially if you're a smaller company kind of running operations with a small team, right? So when we're looking at key person coverage, what that does is in the event of a total disability or death of whoever that individual that's key to operating the business, that policy will then pay the company, whatever the limit that you request. It will pay the company, and the company will be able to use those funds to try and source a replacement, right, and continue operations, right? So a lot of times we see these policies put in place on maybe the CEO. We see a lot of them being placed on the CTO. It's those individuals who are essential to the continued growth of the company. And you can understand why, as an investors, you might see that as a requirement, right? Because if a company or a fund is investing, X amount of dollars into a company, they believe in the vision, right? And if there are individuals that are key to that vision, they want to make sure that they're protected in the unfortunate event that something happens to those key individuals.
So does that typically then just cover the amount of the investment or the size of the round that's being raised at that time, or is it usually some amount larger or perhaps smaller than that?
It's usually some amount smaller. I think it definitely depends on the size of the company as well, and kind of the size of the round and how many outside investors might be looking to join in. Usually we see that coverage of anywhere between 1 million to 5 million in terms of limits, but it's really, really, it goes back to analyzing the risk, right? And some might say it's kind of hard to monetize, just how valuable an individual is to the company. But you have to kind of just do your best job with regards to kind of looking at if this person wasn't there, what would the disruption in our revenue look like? So it's not necessarily tied to the size of the round. It's just more of what can we put in place to operate kind of as a stopgap, to kind of stop the bleeding, right, and give us like flexibility and capital to replace this individual.
And another follow-up we had to that, which seems timely given the health crisis we're experiencing, but does this cover situations other than the death of the person that's covered, perhaps an extended medical leave or anything like that?
So there is coverage for disability, right? So that came into play, at least with the product that Founder Shield offers, the requirement of enhancements into the Disability Leave Act within New York. So life insurance or key person insurance, right? This product now definitely includes total disability, right? So that's going to depend on which key person policy you buy that language there. But if I recall correctly, I think In the product that we offer, it's, I think, 6 months of disability. It either is 6 months or 1 year, right? So that's protecting against, extended disability.
Great. And I know you have perhaps some closing remarks, and we're running a little long, but we had one more question, and just because I'd love to get them all answered, if you have time, I'd love to ask it.
Of course.
Sure. And it's along the lines of director's insurance. How central to the conversation of attracting a director to a board is that coverage? Is it used to, in other words, would you dissuade a director if you don't have this, or is it necessary for them to join the board?
So I would say outside investors generally would be looking for you to have this coverage because they want to be protected, especially if they're going to put someone on the board. I think that most of Series A rounds of funding that I see, it is generally a requirement. Back to attracting investors. If you are approaching, outside investors and you're able to say, I already have directors and officers insurance in place, and you would be protected if you sit on this board and you invest in this company, that's definitely something that's attractive to potential investors. And really, you as a company and looking for outside investors, you should want to partner with investors who understand their risk of partnering with you and providing funding into the company, right? So it's kind of both sides, right? So as a company, it's definitely a attractive kind of look, for lack of a better word, to have it in place. And investors should understand that their personal assets are on the line should an individual sit on board of that company.
That makes a lot of sense. Thanks for answering all of our questions, Rachel. I'm sorry, did you have something else to add?
I was going to say, additionally, right, when you're looking at directors and officers, right, so it's balance sheet protection. That's a lot of, insurance leaders say that when they're talking about directors and officers insurance. And it's really because, if you have claims from creditors, or you and anticipating bankruptcy, or you have that shareholder litigation, the company is being protected. And looking at the shareholders, they want to know that you guys take that risk seriously, and that if they put their investment into the company, that that balance sheet investment is protected.
Understood. Thank you again so much for joining us today and answering all of our questions. It was a really lively discussion around a topic that may not seem exciting at first blush. I definitely got a lot out of it. If you had anything else you wanted to discuss in closing, please go right ahead.
So, I mean, that's pretty much it that I think I covered, in the presentation pretty comprehensively, the coverages that you should be thinking about, and kind of how to avoid the common pitfalls that we see. A lot of our customers come to us, with issues around. I just want to kind of open myself up. If anyone has any questions or whatnot, feel free to email me directly and ask those questions, Rachel at FounderShield. Also, our blog on our online page at foundershield.com, it has a ton of information looking at any kind of risk, kind of exposure you can think of. And there's a lot of information there, and probably will provide responses to questions that you haven't even thought to ask. So definitely would recommend checking out the site as well.
Thanks so much. Hope to do it again soon. And thanks everyone for joining. And stay safe out there, and take care.
All right. Thank you, everyone. Take care.